In today's video, we're going to talk about divorce and home equity. So if you're going through a divorce or you're splitting up, we're going to talk about how to split finances in equity through mortgage financing and how you can save money, so stay tuned. So I recently took a class that focused on divorce financing and how it can help during, divorce proceedings. And believe it or not, now that I've taken this class, there are more and more opportunities for divorce financing because number one, we're in a pretty difficult time, okay, getting out of COVID and figuring out if the economy is super strong or super weak. Interest rates on everything from homes, automobiles, to everything that you may have financed during those COVID times at low interest rates are starting to catch up. And really the job market's not as strong. So whenever there are challenges with family, whenever there are challenges with finance or personal beliefs, that typically starts leading to separation, divorce, and challenges within a domestic partnership. So with us getting a lot more calls and with us getting some comments on talking more about this type of topic, I thought that we should definitely spend some time talking about this today. So you've already established with your spouse or ex-spouse that, hey, this is not going to work, and we have a couple of different options. Okay, we can sell the house and we can split up all the equity. We can refinance the house and give equity to the departing spouse, and then the spouse that wants to keep the house keeps the house and keeps their half of the equity, and they just have to learn how to cope with paying for the mortgage with one income instead of two. So what is equity when it comes to real estate? This is really important. So equity is the amount of money that you have in a house. So let's just say you own a house right now that is worth $500,000. You and your spouse bought this house in 2015 because you were just getting married, just had your first child, everything's going great in 2015, and you bought this house for $300,000. Now you've paid it down to $200,000, and the house is worth $500,000 because we've had these outstanding interest rates. So you have $300,000 in equity in the house. An appraisal's been done, and your spouse who doesn't want anything to do with the house wants their split of the equity. So that's $150,000 that you're going to be splitting to that spouse, but you have overall equity of $300,000. So in this scenario, we're talking about a 50-50 split, okay? So equity is the additional value that is in the house, what it's worth versus what you currently owe on the house. And during a divorce, I would say, split of equity is definitely the top thing, whether it be a 50-50 split, a 60-40 split, a 70-30 split, whatever percentages the divorce attorneys kind of come up with, you would just have to then go out and find the financing. When it comes to refinancing, the main basics are this, okay? If you are refinancing just normal, okay, that's called a cash out refinance. And what is a cash out refinance? Purchase is the lowest risk. Okay, you're buying the house to live in it. Okay, so you're putting your money into the house. Then I would say, second home and investment properties are the highest risk. Okay, so primary, second, investment property. Then the second tier down on the loan level pricing adjustments are going to be purchase, rate term refinance, and then cash out. A rate term refinance is where you're refinancing strictly just to drop the interest rates or better the terms, and you're not pulling any cash out, okay? You can have up to, let's say, $2,000 on most of the loan products, or even $500 depending on the investor and the loan product. You can get up to $2,000 without any problems, and it would still be considered a rate term refinance. And then we get to the riskiest option, which is a cash out refinance. That means you're pulling cash out, and with the pulling of the cash out, now the lender's taking more risk because we're paying off this debt for you. But if you pay off this debt, is there a guarantee that once we pay that debt off, you're not going to go back out and recharge all those bills back up, right? It's really important that you know the differences. Now, here's the thing. When you are refinancing because you are forced to, because you want to keep the house or your spouse wants to keep the house, that is going to be called divorce refinancing. And when you're doing a divorce refinance, the beauty about all of this is that it is not considered a cash out refinance because you're pulling out equity to basically buy your ex-spouse out of the property. So it is considered a rate term refinance, and because of that, it is a lower tier of risk. And because of that lower tier of risk, you're going to save money by treating this as a rate term refinance. Now, this is a guideline, okay, that if you were to just submit your loan up to most investors and they're putting it in as a cash out, if the loan officer doesn't know anything about it, the processor doesn't know anything about it, and the underwriter is just underwriting a loan and they don't know the complete story of the loan, they may just process the entire loan and close it as a cash out refinance. And in turn, now you have spent more money on your cash out refinance than on a rate term refinance. And I'll tell you, on average, we're looking at anywhere between 3/8 to 0.5% difference on the interest rate. And the cost is significantly higher for a cash out versus a rate term. So it's really important that your loan officer, as well as you, know what this entails and the type of loan that you're getting. You have to choose your lender, right? You know, you have to choose your lender and you have to get the house appraised. So that's step one, okay? You've determined that this has to be done. You start an application, you choose the lender, you turn in all your documents, and you get the house appraised. At that point, once the house is appraised, the appraisal is basically a valuation of your property. That is the appraiser's determination as to how much the property is worth based on comparables. And what are comparables? Comparables are, if I am at this house right here, I'm gonna draw a 1 mile radius circle, or 2 miles or 3 miles or 4 miles or 5 miles, depending on where you live. And we're gonna look for houses that are the same composition, whether it be a ranch or a 2-story, the square footage, the same type of composition, the same type of build, you know, brick versus brick or brick versus vinyl. And there's adjustments on all of those different items. So once you get the house determined as to how much it's worth with that appraisal, how do you get a new loan to replace the old one? And that's where we're doing a rate term refinance with equity distributions. So we will then process the loan with that X amount of equity to go as a payoff to your spouse or ex-spouse whenever we do the financing. And you know, they are typically dispersed at the end of the refinance. So if we close, let's say on a Monday, the 1st, on a refinance, there's 3 days for rescission. So Monday, Tuesday, Wednesday, fund, Thursday. Okay, so on the 4th day, everything funds after it's been recorded. So on Thursday, your spouse or your ex-partner will be paid out that equity. Some of the factors to kind of like consider is like, you know, if you want to keep the house or your spouse wants to keep the house, before you go down the road of negotiating the terms of the divorce or the settlement or the separation, I would make sure that a loan officer does review you or your spouse's or ex-spouse's information to make sure that the one party that wants to keep the house can actually qualify for the new loan by themselves with the income that they make and their debt to income ratio and their assets and liabilities. That's the number one step, because I've seen it happen too many times where people file for the divorce, one party wants the house, the other party doesn't want anything to do with it, but guess what? They don't have the income to qualify. And if there's no income to qualify, there's no loan that can be done. So we have to make sure they can qualify by themselves, or that person that wants to keep the home has a co-signer that can jump in and help them co-sign as well. We have to make sure that the credit scores and income are good, okay? The income has to be likely to continue, and the credit scores are workable with the different types of loan products, whether it be a conventional FHA, VA, USDA type loan. And we have to look at the potential impact of the taxes, especially if you're going from, you know, 2 household income to a single income household, and the importance of clear communication and clear agreements when it comes between the 2 parties that are separating. So it has to be very clear how the equity is being split, and that there's going to be no pushback from the other party when it comes to doing the financing. Divorce is a very, very sad situation, and one of the, you know, bright sides that I could say is that, you know, the house is the biggest anchor when it comes to, you know, keeping that divorced couple who don't want anything to do with each other tied down together, right? So getting your refinance options when it comes to divorce and home equity are very important. So I would highly encourage you to reach out to your loan officer, or if you don't have one and you have questions on divorce and home equity, please feel free to give me a call. My name is David 𝐬𝐲. I can be reached at 757-478-8493, and I will be honored to help you out. Talk to you later. Bye.